And the last session, we review different topics. We reviewed the different kind of securities. Remember, we have four kinds of securities that are equity securities, debt securities, hybrids, and derivatives. And derivatives have other four types, no? Futures, forwards, option, and swaps. And each kind of security, each kind of derivative obviously has its own characteristics and purpose. So additionally to the type of security, we check this graphic in which I show you that all the time when we were working with securities, return and risk are concepts very, very associated. Then we check if we are the company that is emitted securities, how in which place the securities are going to be shown, and we review the balance sheet if we are the investors. So additionally, in the last part of the lecture that we have the last Monday, we review some associated concepts like a centralized exchange that are official markets, over the counter that are not official markets, maybe because there's no derivatives, there's no market for the product that the investors, that the parties want to trade. And this is a very, very important concept. We check broker, we check dealer, we check this graphic that shows in general how is the operation of the securities. And finally, we review primary market and secondary market. Remember, primary market is when the company has an IPO that is the initial public offering, and it represents that in the market the company that is emitting securities has direct contact with the investor. So in the case of secondary market is when the company has already emitted the securities, and in this case, in secondary market, the investors are the parties that have this contact that create this trading. No, in the secondary market, yes, investor can get in touch with the company, but it's most common that the investor get contact with another investors. And finally, we check the impact of regulation and procedures used in trading security. Basically, the impact of the regulation is to maintain a healthy and competitive environment, and obviously avoid fraud, manipulation, and or fair trade practices. But now we are going to check what is regulation, why regulation is important, and why regulation is fundamental in this in the banking sector, in the financial sector. So regulation attempts to prevent, identify, and punish investment industry behavior. Regulation is a set of standards of conduct, set of laws, set of rules that normally are enforced by the government and by other international authorities in order to dictate the way in which the participants in the banking sector, in the security sector, in the financial sector must to act. So here we have the industry, and regulation could be represented by laws and standards and other regulation, but also regulation includes professional standards, like, for example, the accounting standards, ethical principle like the code of ethics of accountant, the code of ethics of brokers. So it's not only laws and regulation dictated by the company, normally are dictated by the government, but also by another organism or organization. And the fourth part of regulation is company rules, practice, and procedures, because even when the company knows laws and regulation, professional standard, ethical principles, is important, and that the company has these policies, and the policies are in aligned to the laws and regulations. So for that reason, I like this picture, because it's not only one part, it's not only laws, is we can see different types of regulation that are protecting the trust in the industry or the trust in a certain company. Now, this other picture shows the process of regulation. This process starts when someone perceives a need, when someone identify that a gap or a problem in regulation. So this person could be an employee in a bank, or could be maybe some banking supervisor. So it doesn't matter who is the person that discovered this need. The process starts when someone perceives that the sector needs a regulation. So when someone detects this necessity, legal authority or banking authorities create a draft of regulation, create these laws in order to cover this necessity. And then this draft enters in an analysis. Imagine that the policy area created a regulation, and this policy area needs to send this draft to another areas inside the authority. Probably if it's a regulation related to listed companies, probably this draft will be sent to the supervisor of listed companies, no? Or if it's a regulation in terms of I don't know, IT, or how to use, I don't know, contactless, probably this regulation will be sent to the specialist in IT. So this period is called analysis. And then this draft that contain all the comments of the experts needs to publish, but not formally, publish for consultation. In this process is when the public, when every person could send comments to this draft before to be emitted. So this is a period when every person could give an opinion. Then obviously the legal authority takes these comments and includes the comment that the authority considers that are important, and delete or erase the other comments that probably the authority consider that are not correct. And after this public consultation, the next stage is the adoption, is when the rule, the regulation is emitted, but formally. And when it's emitted formally, obviously the entities on or the regulated individuals needs to insert this regulation in the normal practice. And this insertion is very related to the implementation, how the companies could insert this new rule in the normal operation. So this process is called implementation. After implementation, we have monitoring. This is a process crucial because we are checking that how the rule is working, and if we need to change something, or if we need to change something in the regulation, or probably in the process of the company, no? And when we monitor the adoption and the results of adopting a regulation, this thing, when we notice these things that we need to change, this is enforcement. But because now we know that the regulation work in a certain manner, but we need to change something because one thing is the theory, is the regulation, another thing is the practice, how the rule is working in the real life. And then we have a dispute and resolution, is when a company or a regulated person or company are not following the law. So obviously this behavior need to punished, and this is a dispute resolution in which we detect that someone is not following the rule. This is the dispute resolution, and then again review. Why? Because obviously we learn from different difficult circumstances, you know, and if we punish someone, we need to be coherent to punish the same behavior, no? And obviously regulation, it needs to be reviewed constantly. So for that reason, the last part of this diagram is a review. Now we have objectives of regulation. One of the main objectives is not the most important, but is one of the objectives is to protect consumers from abusive and manipulative practices. If we have regulation, we have a structure, and even we have a section in the regulation that tell us what is going to happen if someone doesn't follow the rule. So what would be the result? Maybe an economic result, maybe an ammunition. So in order to protect the customer from abusive and unfair practices. And another objective is foster capital formation and economic growth. This is important in financial regulation because at the end, banks and financial entities needs to put the money in different segments of that are important for the government. And this allocation of capital increase the economy and is very helpful to maintain stability in a country. And other objective of the regulation is support economic stability, because with the regulation we are avoiding bad practices that could disrupt the economy. What happened, for example, in the crisis in 2009, that nobody realized that the model in which many banks were working in a certain point disrupted the economy. And after during the crisis, a lot of people suffered, and many countries suffer too. So this is one of the objectives of the regulation: maintain the stability in an economy. No? And the other objective is ensure fairness. This concept is very related to asymmetries. Asymmetries is when one part of if we are trading, for example, securities, one part has more information than the other part. So this not balance in terms of information is called asymmetries. So one of the objectives of regulation is try that the gap between asymmetries gets reduced, because with regulation, probably the regulator could ask information to the company in order to show this information to the investor and maintain a balance in terms of information. So obviously, reducing asymmetries is an effect of a regulation. Another objective is enhance efficiency, because regulation standardizes documentations and reports. And obviously, if the reports and the documentation that the companies needs to send to the authority are standardized, is easy to get conclusion, and it's easy to compare. So if it's easy to compare and if it's easy to take decision, even if the information comes from different entities, it means that regulation is important to be more efficient. And another thing, and I feel that this is very, very like fundamental, is improve society. Why? Because regulation helps to a country to boost a certain segment. For example, if the government wants to increase the availability of credit financing for a specific group, regulation could, the government couldn't meet a regulation. Or if the government wants to encourage home ownership, probably through regulation could launch some programs that help people to get a credit to buy a home. So at the end, improved society is one of the objectives of regulation. And in fact, when we are talking of improving society, is because regulation prevents that the financial entities get used to criminals to finance the activities like the terrorism, money laundering, or this kind of practice that are against the society. So these are the objectives of regulation. Obviously, these objectives are not the only ones. We have more than these, but in general terms, these objectives are the most important. And regulation needs to be monitored, as we see in the diagram of the process of regulation, needs to be monitored by regulators. So the regulators are these government institution in charge to review the correct functioning of the financial entities and or the entities that operate with money and with securities. Here in the UK, we have, for example, the Financial Accounting Authority, that is the regulator of London Stock Exchange. Or for example, we have the Securities Exchange Commission, that is the regulator of the New York Securities Exchange. So these two bodies needs to protect the interest of the consumers, the interest of the public, and for that reason, they need to guarantee that entities like London Stock Exchange and New York Stock Exchange are following the rule and are following the regulation. Now we are going to check some concept in trading rules. The first of them is market standard. Market standard refers to the time between a trade and the settlement of the trade. So remember, in market, we need to close operation normally at the end of the day. So market standards are useful to know what is the time that that a person or that a party has to close an operation. Another concept is market manipulation. In market manipulation, it refers to this kind of practice in which, for example, an investor is investing in a certain security, and a lot of investor gets agree to invest in a security in order to decrease the price of another security. So these investors or these people are not letting a natural behavior in the market, because they are doing something that alter the normal behavior of the market. So this is market manipulation, and obviously is not permitted by the regulation. And another concept is insider trading. Is when it's very similar as market manipulation, but insider trading obviously is internally in the company. Is when, for example, imagine a broker, and this broker knows that someone, that a client, that an investor wants to invest in a certain product or in a certain securities. So obviously, because the investor wants to enter in a certain market, the broker start to search a lot of information. And imagine the broker could realize that the opportunity is very good, and the broker could lie to the customer and say, no, the investment is not good, only in order to the investor let leave the investment, and the broker takes this investment. So it means that the broker used the intention of the customer or of investing, and then he realized that the investment was very profitable, and then because the broker at the end is a guide for the investor, at the end the broker could say, okay, the investment is not good, only to persuade the investor to leave this investment, and the broker takes this opportunity. So this is insider trading. And another is front running, is when the employees inside of a investment bank are using the information to get personal benefits. For example, when a broker recommend to an investor invest in a certain product, probably because if the investor invests in this product, the broker could have a more elevated commission. So in this case, front running is that kind of practices in which the employees are getting personal benefits, are taking professional benefits because they have in a privileged position. They have privileged information So this is basically the meaning of front running. And another, as we see at the beginning of this lecture, regulation normally are made by the government, but also by international bodies, and these bodies emitted normally international standards. And international standards are important because of the globalization. Now investors can buy and sell every kind of securities everywhere, anytime around the world. So for that reason, international standards are very important to protect the investor, but now not for local purposes, but in this case for international purposes. No, it doesn't matter that you are from a certain country. International standards look for protect you, even if you are from Germany or from Canada or from Brazil. So for that reason, international standards are very important and are more important nowadays because of globalization. And to have international standards is necessary the standardization. It means that all the companies follow a certain structure. The structure is very helpful for investors to compare and to take better decisions. So at the end, international standards are looking for this standardization to show a picture clearer and easy to read. And because of the most powerful countries have adopted international standards, and other countries like developing countries are following the same practice as the same practices as the most powerful economies. So nowadays, many of countries are following international standards. The most important organization that emit international standards in terms of securities and trading and markets is the International Organization of Securities Commission. And this organization creates high standards of regulation. One of the highest standards of regulation that the International Organization of Securities Commission emitted was the principles of this organization, that is basically a set of rules that is a guide, because it's not mandatory, but some countries that want to adopt international standards could use these principles to formulate and to create regulation in the country. So this organization, the most important members are the G20. It means that we can find here the USA, Canada, Spain, the UK, probably Switzerland. The most powerful countries in the world are the members of this international organization. And because this organization, as I told you, emitted the objective or principles of securities regulation, that is a certain is a guide that countries could use to create regulation. So these objectives and principles of securities regulation were emitted in 1998. And the main objective of this principle is providing information for effective security regulation. And this document, the objectives and principles of securities regulation, are divided on three objectives. That is the protection of the investors, ensuring market fair and efficient and transparent, reduction of systematic risk. Remember that systematic risk is the risk or is the probability of a breakdown and resulting in a severe economic turndown. So systematic risk is this probability that something happened in an economy that affects not only one entity or not only one sector, the whole country. So this is one of the objectives of this principle, the reduction of systematic risk. So in the principles and objectives of the International Organization of Securities Commission, we can find 8 categories depending on the topic. But in these categories, we can find, for example, principles and objectives for the regulator, or another segment for self-regulation or for users, and for market intermediaries, for second markets. So depending on the figure, the role of the participant in this in the market, we can find a certain area in the principles and objectives of the International Organization of Securities Commission. So we have 8 categories. And additionally to the local standards, international standards, it's also important company policies and procedures. Why policies and procedure? Because in investment industry, all the regulators and all the supervisor and even the investor are expected to have that the company has policies and procedures, has this way of working. So policies, the difference between policies and procedures are that policies are principles of action adopted by the company. This is like the theory, and procedures is the way in which the company normally acts. So the theory, the policy said, okay, you need to, for example, maintain the information updated, no? But what happened with the procedure? The procedure could be said, okay, in order to maintain the information updated, you need to use this program, no? This is the difference between policies and procedures, and obviously policies and procedures are fundamental to protect the trust in the industry, the trust in the company. Although policies and procedures are not forced by the law, I mean, the regulator or the authority cannot say, okay, you need to insert this policy and you need to insert this procedure. The authority doesn't have this faculty. The authority only says you need to have policies and procedure in order to protect, for example, the investment of your customers, no? Or you need to have a board of directors that take decisions, but the company never says you need to do this and you need to do that, because is the decision of the company. So in the second part, we are going to analyze the principles of investment theory, analyze the valuation of shares, debts, and other financial assets, and review the underlying concept of market analysis and market efficiency. So for now, we have finished the first topic in this second class. So for now, this is everything in the first part of the class. Then in the second part of the class, we are going to review more about investment theories. investment theory, securities, and market analysis. First of all, I'm going to explain the principle of investment theory. Then we are going to analyze the evaluation of shares, debts, and other financial assets. And finally, we are critically review the underlying concepts of market analysis and market efficiency that these concepts are very famous in this industry, in this financial sector. Investment theory. The investment theory is a concept that is very close and very associated with the process of investment. So if we have the opportunity to hear about investment theory, it means that investment theory will imply the process of investment. This concept of investment theory is when we are looking very close a multiple factor to determine how to go about choosing the right investment. Is when we are looking at the market to determine and to analyze the conditions of the market and take the best decision in order to reach a specific goal or a specific purpose with our investing with our money. And investment theory involves another theory. So I will say that investment theory is like the main concept, but investment theory at the same time implies another theories. We are going to check the most important because there are multiple theories, but we are going to check the most important or the most famous. So remember, investment theory is when we are looking very close the behavior of the market in order to invest and reach a specific purpose or goal. Before to start discussing the different theories, there are some key factors in investment theory. The first factor in investment theory is when the investment theory needs to follow a goal. We need to have a goal if we like as an investor, if we decided to invest in a portfolio. Portfolio basically is a combination of different securities or different instruments. Is when we have multiple securities, not only one, multiple securities. For that reason, because in a portfolio we have multiple securities and multiple investment, we need to use diversification. Diversification is when we don't put all your money in only one security. Is when we divide our an equity security, and we notice that the price in this equity security is decreasing. Probably if we have a very diversified portfolio, we are going to lose not all our money, only one part of our money. So it means that diversification reduces the risk. And this way of investing is called modern portfolio theory. Is when we are investing in a portfolio created with multiple securities, not only one. These are the basic concept of the whole picture of the modern portfolio theory. Another factor when we are evaluating in investment, or basically investment theory, is when we are evaluating according to the degree of risk and potential return. If we come back to this diagram, in which we have here return and we have here risk, these two concepts, risk and return, are very associated, because if we don't have a lot of risk, we don't have a lot of return. But if we have more returns, we have also a lot of risk. So if we are analyzing an investment according to risk and return, let me find this is the second factor. When we are analyzing the level of the risk and potential return, this is when we are talking about capital asset pricing model. That is another investment theory. We are going to see some of these examples. So a similar approach to capital asset pricing model is arbitrage pricing theory. Is when we are evaluating the degree of risk associated, but only with one investment option. In this case, when we are using, for example, capital asset pricing model, we are analyzing risk and return, but in a portfolio. But when we are using arbitrage pricing theory, is when we are analyzing the degree of risk and return, but only in one type of security. We don't have here a portfolio. We have here only one investment option. And why only one option? Because this kind of investment analysis helps to see how volatile is a security. So for that reason, we are analyzing only one security, not a portfolio, because we need to see if this security is the behavior of this security is fluctuating. How is it fluctuating a lot or not? So for that reason, in this theory, we are analyzing only one security. And the third factor in investment theory is the amount of information that we can review in the economic situation, no? So the third factor is when we use this information that is available to take a decision, to see if the behavior of the market, and then take the best decision according to our purpose, the purpose of our investment. So when we are taking this information available, we are talking about efficient market hypothesis. And with efficient market hypothesis, we can realize this moment in which we can sell or buy an option, or in this case, a security. Is when, for example, if we see that the price of a share of or maybe a derivative is increasing, is the time to sell this security, or if we see that the price of a security or a financial instrument is decreasing, is the time to buy this financial instrument. So efficient market hypothesis is when we are using this information that the market has to decide if we are going to hold the stock, if we are going to sell it, or if we are going to buy it. So this process is called efficient market hypothesis. Essentially, an investment theory is about making informed investment decision, taking in consideration, obviously, the desires of the investor, in order to construct a portfolio and reach a specific goal. And here we have the principles in an investment theory that basically this is a summary that includes the capital asset pricing model, the model portfolio theory, and the efficient market hypothesis. Why? Because the principles in an investment theory is identify the investment portfolio that is very close to the model portfolio theory, in which we are analyzing the investment portfolio. Balancing that diversification with the type of individual securities, that this second point is very associated to model portfolio theory. We need to be very, very careful in how divide our money in order to invest and in order to diversify our money in different type of securities. Also, another principle is evaluating investment based on the degree of risk and potential return. So we need to see what is of a risk appetite in order to select the security that match in a better way with this risk appetite. If we are very aggressive, maybe we can choose these kind of securities that offers a lot of returns, but at the same time, the securities that are riskier. And the number 4 is consider the amount of information available, because in this industry, all the prices are moving according to the behavior of the markets. And the point number 4 is very associated with efficient market hypothesis. So remember, the principle in an investment theory involves all the theories that we check in the factors of the investment theory. Now, let's check a little bit more about portfolio theory. The modern portfolio theory was created by Harry Markowitz in 1952 in a paper called Portfolio Selection. So basically, this theory is based on risk and return, and the characteristics of risk and return needs to be together. They need to have this connection, because we cannot see risk and return in a separate places. We need to see what kind of risk, what kind of return, because these concepts are very, very close and very, very associated. And for example, we have here an example of the portfolio theory and how we can diversify our money as an investors. The expected return of the portfolio is calculated as a weighted sum of returns of the individual assets. For example, we have money, that as an investor we have decided to invest. So following this modern portfolio theory, we are going to diversify our money in different kind of securities. So probably as an investor, we decided to invest 4%, 25% in equity, 25% in debt securities, 25% in hybrid securities, and 25% on derivatives. So we need to check what is the interest rate that offer this kind of securities. For example, if in equity, if the equity offers a 4%, we are going to multiply this 4% multiplied by the weight of the money that we have assigned to this kind of security. So the formula is so basic and it's so easy. So we need to multiply the return, the percentage of return, by the percentage of the money that we have assigned to this kind of security. So 6% maybe if we have invested in debt securities and the debt security offers 6%, we are going to multiply this 25% plus multiply by 6% and go on, no? So at the end, our portfolio is going to offer 8.5% of return. So is the way in which we can apply modern portfolio theory, no? Here I have probably this formula is better if we can check in this picture, because we have here the weight, the percentage of the portfolio, and we have here the expected security return. How much, what is the percentage that each kind of security is offering? So we need to multiply, and we have the percentage that the whole portfolio is offering. So this is modern portfolio theory. That in this modern portfolio theory, remember, we need to have 3 elements: risk, return, and diversification. And then we have the capital asset pricing model. That this model describes the relationship between systematic risk and expected return per asset. This is particularly only for stock. It means equity securities. So in capital market theory, extends portfolio theory and develops a model for pricing all risky assets. So, and this model used to determine the required rate of return for any risk asset. But here, remember, even when a capital asset pricing model sounds like the portfolio theory, here we are using information in the market, available in the market too, and how is the behavior of the market. So we have here the formula to determine the capital asset pricing model. We have here the expected return, the risk-free rate plus beta, and then the expected return, but in the market. This E is the expected return for the investor, and this with M is the expected return in the market minus the risk-free rate. So how we can get this, for example, beta and the expected return in the market? If we check different kind of index, for example, Standard & Poor's, on Bristol, GSMI, we can get these numbers, no? So we need to check this kind of index to see what is the amount or what each formula. So we have here a return of the market, a risk-free rate, and we hear that we need to decrease these two concepts to get this part of the formula. And this part of the formula, and even we can use the risk-free rate to this part of the formula. But how we can calculate beta, or what is beta? So beta, in this case, beta measure the amount of the systematic risk in an individual security or in an industrial sector. Beta measure the behavior of the systematic risk in a market. So normally beta is always 1. So if we have for example, a stock, because remember, capital asset pricing model is only for equity securities. So if we have an equity security that is very close to beta, it means it's very close to 1. It means that the risk, the systematic risk is not very, very huge. So why? Because beta is very close to 1. But imagine that beta is 2. So is the gap very big. It means that the systematic risk is a lot. So beta is the way in which we can measure the systematic risk. What that this equity stock is very volatile. Example. Suppose that a securities beta is 1.5. It means that is 50% more volatile than the market. So we need to keep in mind that beta is always 1, but the beta of a specific security is going to measure how volatile, according to the market, is this security. And this is a way in which we can obtain beta. Obviously, beta we can consult to in different indexes that are these indexes are public for anyone that want to check. So this formula, we can get this. We can get the numbers of the quantities or the figures for this formula only if we check different kind of indexes. But now we know that beta measures the systematic risk, that expected return of the market is the expectation of the market, and the risk-free rate is this rate that doesn't have risk, that is very sure that we obtain this return. And now we are going to check efficient market hypothesis. Efficient market hypothesis is a term that was introduced by the economist Eugene Fama in 1970. And basically, this theory is based of consider that all the markets are efficient because all the information is considered has been considered to reflect this information in the prices of the securities. But the information is not limited only is not determined only for because of the financial news or market research or analysis. The information in markets or the prices that the market reflects also covers another factor like economic behavior or political and social events or social issues. So it means that efficient market hypothesis says that all the prices contain all the factors: news, market research, political, economic issues, or a combined of factors. This is the efficient market hypothesis. Example, Suppose that Pfizer, this company that is very, very famous in pharmaceutical sector, announces a new allergy drug that could completely prevent fever. Or let's think the Pfizer, when Pfizer announced this vaccine for the COVID, no? How should the share price of Pfizer react to this news? Consider the three hypothetical paths for the price adjustment. What happened when Pfizer announced, I have the solution for the COVID, I have the vaccine for the COVID? Do you think that immediately the price of the equity securities of the stock of Pfizer in the market increase immediately and then recover the equilibrium level? Or do you think that when Pfizer announced the vaccine for the COVID, the increase in the price of the stock market, of the stocks of Pfizer, increased gradually, or at the beginning was increased and then return to the normal situation and then went to the equilibrium level? So this kind of three reaction could be possible with the efficient market hypothesis, because depending on not only the financial news, probably the information, the reaction was determined by the economic condition of the country. Maybe one country decided, okay, I'm not going to use Pfizer, I'm going to use Moderna. And for example, in this case, the price of Pfizer decreased in certain country. So this is an example how the prices in the market are affected by external and internal events. No, so basically here we don't have a right answer. It's depending on the information available. This is an example of a efficient market hypothesis. And we have more theories, more investment theories, like flow of funds theory or random walk theory, on trend walk theory. We are not going to review these other theories, but I want that you know that we have more than these theories that we have checked here in class. No, we have more than this. Now we are going to enter to the valuation of shares, debts, and other financial instruments. Now we review the theories that help us to invest. But what about the valuation of each kind of security to be recorded in financial statements? Or how the market determine a price or a value for each kind of security? So we are going to check now. We have first the equity method. The equity method is only used for equity securities. Let's talk about, for example, joint ventures or significant influence investment. But remember, this is only for equity securities. Because why equity securities? Because securities are trading in a market, and the market, depending on how profitable is a company, or if the company is strong or not, or the perception of the investor, the value in the market of a company is going to increase or decrease. So basically, this is the equity method when the stock of a company is participating in a market, and this market, depending on different events, determine the value of each share of the company. So basically, the valuation or in the equity securities are determined by the market in which these securities are traded. And another let's see, way to evaluate shares that another financial instruments, it's a fair value through profit or loss. But this is also for equity securities, but this is more associated. Do you remember, for example, when we were checking the equity securities that we have common stock and preferred stock? In common stock, we can if we have common stock, we can decide the inside the company, we have voting rights. So in this equity method, we were talking about the valuation in equity in common stock. But in this other method, we are talking about equity securities, but in preferred stocks. No, sorry, in preferred stock, and this is in common stock. Because why fair value through profit loss? Because here in this method, we consider if the company has earnings or not, if the company was profitable or not. Because if the company was profitable, the investors or the shareholders are going to receive more dividends. Okay, so the fair value through profit loss is recognized in the balance sheets, and if the company was profitable and we have earnings, this income is going to record in the income statement. And then we have another method that is called amortized cost method. But this method is only for debt instrument. So we checked equity securities, but this method, amortized cost method, is only for debt securities. We cannot use this method for other securities, only for debt. Why? Because this method collects all the process of the debt securities. Remember that debt securities are very similar as a normal loan. So we have here the formula how we can determine this method. First is the total acquisition minus their principal repayments plus principal repayments is when the company is paying, is returning the money to the investor. So the total acquisition minus the payments that the company has returned to the investors plus any discounts or premiums minus any impairment losses and exchange differences. So through this method, we can record the value only in debt securities. So we have here the formula to know what is the cost of a debt security or a debt instrument through amortized cost method. So the most important accounting issue for financial assets involves how to report the values on the balance sheets. So we need to be very careful when we are reporting the values of every security in the balance sheets, because we have many methods and we need to be very, very careful to choose the correct method according to the type of security. But the methods that we check don't mean that are the only methods or the only technique that we have available to determine the valuation of the shares, debts, and other financial assets. We have plenty of techniques, but obviously the company needs to justify what technique is using. So a company, we can use the method that I have mentioned, but is not limited. They can use a lot of methods and a lot of models. When investments are very small, the current prices, the current market price is relevant measure. Yes, because maybe the company doesn't have the resources to develop a new method, no? So the most efficient method is see the market, what is the reaction of the market or what the market is saying to evaluate securities. But for example, in big companies, not only the market price is the option, no? In big companies, even they can develop their own internal methods to evaluate securities. And now, to finish this topic, we are going to review two important concepts, that is market analysis and market hypothesis. In market analysis, we are examining the market size, segments, competition, economic environment. So is when we consider all these factors to take decisions, no, or to see what is the value of a share or the price in a stock. So basically, market analysis is when we get plenty of information to take a decision, to know something about the price or to know about something, something about the valuation of a security. This is market analysis. And market efficiency is the same as we checked with the market efficiency hypothesis, is when market efficiency assumes that all the markets are efficient because all the information available is reflected in prices. So these two concepts are very, very close. Market analysis is when we determine the price of the behavior according to different information, and market efficiency is very close. But first we have a premise, and this premise is that markets are all the time efficient. So we don't have, in market analysis, we don't have this premise. But in market efficiency, we have this premise that all the markets are efficient, and we are assuming that that all the markets have taken all the information available. I will say that is when in market analysis is when we had doubts about the information and if the prices contain all the information, and in market efficiency, we assume that the prices contain this information available. So to finish, let's check topic number 3, that is understand the legislation and regulation controlling the financial services industry. And we are going to discuss the legislation and regulation to control the financial services industry and the main features of legislation and regulation to control the financial services industry. Financial regulation in the first part of the lecture is important and is held through supervision, supervision or who through regulators, no? And these regulators normally are the government, or probably they could be non-government organization, for example, like this international organization. Financial regulation can also influence the structure of banking sector, because remember, banking sector is very important, because banking sector is helpful to allocate capital and to boost any a specific sector depending on the necessities of a government or a country. So financial regulation is very close to banking sector. And we have objectives that most of them we have checked in the first part. I'm not going to repeat this concept, but regulation in financial sector has its objectives too. And according to Kasu, this author identifies 3 types of regulation. One is systematic, that is concerned about the safety and soundness of the financial system. Prudential, that is worried about the protection of the customers. And conduct of business regulation, that is more focused on how financial entities drive their business. So normally here in this lecture, we are checking, yes, systemic and yes, conduct of business regulation, but more of the regulation that we have checked is prudential regulation. Why? Because it's focused on protecting the interests of the investors. And regulation in financial services start from the structure of supervision, no? First, supervision of a stock exchange, because remember, the stock exchange is the place in which all the securities are traded. So obviously a stock exchange needs to have a regulator. So this regulator used to see if the stock exchange are working according to the best practices and according to the law. So it's very common to see and that the stock exchanges are supervised by the government or international bodies. So we have in the structure supervision of a stock exchange, but also we have a supervision of listed companies. These listed companies, remember, that are companies that emitted debt or emitted equity or emitted derivatives. So because these companies are taking the money of plenty of investors, they need to be supervised too. So on one hand, we have a supervision. This supervision is held by the government, but also the government supervise listed companies. Remember, these companies that have emitted a debt or equity securities or hybrids or derivatives. And also we have here, for example, we have some of the regulators in supervision listed companies, and also we have a supervision of bank and financial services providers, because remember, banking sector plays a very important part to maintain stability and economic growth in each country. So for that reason, banks needs to be supervised, because at the end they have the money of savers, investors, lenders. So for that reason, banks and other financial services provided needs to be supervised by an authority. that normally is the government or an international authority too. And in terms of banks, a very important regulation was created by the Basel Committee on Banking Supervision, that this committee created the basic principles of effective banking supervision. This is not mandatory. These principles are not mandatory, but a lot of jurisdictions use these principles as a guide to develop a better regulation. And why use this guide? Because these principles were created by the G10. The most powerful countries in the world created these principles, and a lot of countries are associated to this Basel Committee on Banking Supervision in order to have a regulation that could be comparable with any country in order to standardize information. And the principles, this is a structure of the principles that the Basel Committee has emitted. And basically there are 29 principles. The first 13 principles talk about supervision power, responsibilities, and function. The next principles talk about prudential regulation and requirements. Remember, prudential regulation is a regulation that is concerned about the protection of the investors. And the last part of the principles talk about the third-party cooperation, for example, with another jurisdiction, and probably with external auditors or external parts that could contribute to have better regulation. And this is a comparison between the benefits and the cost of regulation in financial sector. One of the benefits is address on unwanted negative effects, because obviously if if financial services industry has a regulation, the regulation is preventing all negative effects that could be generated in this industry. Another benefit is encourage competition. Another is improve customer protection. But obviously, every benefit has its own cost. Cost is cost of compliance, because obviously if a company wants to follow a rule, they need to design practices and procedures, and obviously it has a cost. So the cost of compliance is not a negative part, but is something that the financial entities needs to keep in mind. Barriers to entry in markets, because obviously one of the parts of the regulation says that not all the companies could participate in different sectors. They need to comply different requirements, and probably for some companies the requirements could be difficult to comply. So this is called barriers to entry in a specific market. Another cost is customer taxpayer detriment from ground regulatory action. Obviously, if the companies or if the financial entities don't follow the rule, they could be punished. Or also, this cost is associated, for example, if the banks need, sometimes they pay some fees to certain bank association in order to belong to this sector. So this is another cost. Okay, so we finish here. I'm sorry, because I think that in the last part I went very, very fast, but otherwise the time will be not enough. So, but we finish, but not sure. So do you have any comment or any doubt, Anna?
Hello.
Hello.
Hello. Yeah. Hi, Eureka. How are you?
Hello. I'm fine. You?
Yeah, I'm good. You hear me?
Yes, of course.
Yeah. Just I have a question. Now, suppose I want to buy shares. I mean it's like equity share. So, as an information of the company, I see that the beta 1.5. Okay, so as I know, it's not should be like that. The meaning of 1.5 is it? I just want to confirm that. It means not bad, but it's like the company. It's like we can say like shaking, or it's not established. I mean, it's like suddenly going up and down like that. This is the meaning of 1.5. Because as a normal, I mean, if the company is it's on the working like on the perfect way, it should be like about 1 or around 1, like 1 or 9.8 or something like that. Is it? Or
yes, totally right.
So I want just to confirm that. So suppose in the future I want to buy some equity. So just I want to confirm. So I means that I can buy also, right? Like 1.5 or 2, suppose, but it's like more risky than one or
yes, is more volatile.
Yeah,
for example,
so I mean,
you expect
more
that
risky,
exactly,
but it's still okay, right? I mean, I can, and I mean, okay, right? But it will be like maybe I will get more loss or more, or more profit. I mean, maybe high profit or maybe high loss, right? Like because of this, it's not stable, right?
Exactly, because remember, risk and return are two concepts that are very close, and obviously if the beta is showing that is volatile, it means that beta is fluctuating and this equity is fluctuating a lot, and probably you can get a lot of returns because it's risky. It's riskier than another equity, but yes, you can have more returns, but it's riskier.
So this is like depend on the investor, right? Like some people like to go with this. Some people, I mean, they like only to go with a normal situation, like around 1.
Exactly.
So like I mean, risk more. I mean, like normal. I mean, suppose I don't like to go with more risk. So better to find something around 1.
Exactly. Yes.
I will not get high profit. In the same time, I will not get high risk.
Exactly.
Okay.
Yes.
Yes. Get
you
it.
are right.
Yeah,
you
perfect.
Totally
So,
right.
yeah, just I want to confirm that. Yeah, perfect. So, I have thing. Can you just go to the slide of arbitrage pricing and the modern theory that I think I have no. Just I want to take a screenshot so I can. Because actually the recording, it's like I think taking time, sometimes like 2 weeks. So,
yes,
yeah,
I
10
know.
days.
Let me put the equity method. This is beta. You mean this theories, no?
The
Investment theory.
arbitrage, yeah, the 3 arbitrage, and there is a modern.
This is you are talking about this.
Yeah, this one.
Sorry,
But
this is a first. If you
yeah,
can take a.
but is it really good? This is really okay. Yeah, I will get this one. I will get this. But isn't this important? Like in investment, this is like only for what exactly? This theory is what can help. I mean, as I am investor, what can this helping me? I mean, see, it's like I feel that like this is only for studying, only as a book and as right. Is it this? It's not important as I'm investor. This is helping me. I don't think so, right?
I feel that if you are an investor, I mean, if you are not a company or something like this, If you are
No.
an investor, I feel that the modern portfolio theory is very basic, very, very like clear, because remember, modern portfolio theory measure the amount of money that you are investing in a certain security multiplied by the percentage of return that this security is offering you. So it's very easy. If you have, for example, 100 pounds and you say, okay, I'm going to invest 25 pounds in an equity security, and you see that
diversification.
Exactly.
Yeah, correct.
So
correct,
it's
correct.
very easy. So I feel that the easiest one is the modern portfolio theory.
The modern portfolio is the same diversification, right?
Yes,
Yeah.
because in fact, the modern portfolio theory contains this concept of diversification.
So this is most of investors doing. I think. This is the normal one, which is the modern one, right? This is
Exactly.
the
Exactly.
So
Capital
what
asset.
about?
Sorry. Tell me.
Yeah, go ahead. Yeah. Okay.
I feel that capital asset pricing model is more for companies or bigger investors.
The capital asset. This is what exactly again? If you can just a quick. This is, I mean, what is the difference between modern? Modern, we understood that, but I mean the capital asset and arbitrage. I mean one option that arbitrage talking about. Like if I want to go with one option or
capital asset pricing model is when we are talking about beta. So
beta.
if you see capital asset pricing models requires more knowledge about the behavior of the market. So because why? Because if we are using capital asset pricing model, we need to know the concept of risk-free rate. We need to know the concept of beta. We need to know the concept of expected return of the market. So for this concept, we need to check a different index, for example, Standard & Poor's. So it's not difficult, but I feel that capital asset pricing model requires a little bit more knowledge, and not in modern portfolio theory. Modern portfolio theory, I feel that is very basic.
Yeah, I get it. And what about arbitrage pricing theory?
This is very similar with capital asset pricing model, but remember, in capital asset pricing model, we are evaluating a portfolio. And in arbitrage pricing theory, we are evaluating only one security to see how volatile is only the security.
Okay.
But basically it's the same. But in asset capital pricing model, we are evaluating a portfolio, many securities in the same bath, for example.
Okay. And the capital assets not about portfolios. It's
yes, because at the end, capital asset, the modern portfolio theory is a portfolio too, because remember, we are associated a weight of each kind of security in which we are investing our money. For example, we have 25% in equity, 25% in debt, and the rest in derivatives. So at the end, this is a portfolio too.
Yeah. Okay. Yeah, I think because the portfolios usually, that all for any investment it should be there is a portfolio, right? Or what do you mean that maybe we can do something without portfolios, like?
Yes, I feel that for me the better or the best, the easiest, the clearest is the modern portfolio theory.
Okay. Fine. Okay, clear. So So this is the part, only part, right? I mean, there is another part now, or only this for today?
This is for today because in fact we started. Did you take the screenshot of